It may look undervalued, but at what price is Lockheed Martin a buy now? We'll find out when we run it through our valuation model, getting to our intrinsic value and acceptable buy price. We'll also take a look at some of the risks that they do face, as well as some of the positives that we should know in terms of Lockheed Martin. It is the largest defense contractor in the world based on total spending, so this is a very big company. What are the risks? What are the positives? And what price should we be looking to buy this undervalued company? Well, year to date, they are down around 6%. As we can see, they are in the midpoint of the 52-week range, and they do offer a yield of just under 3%. Now, if you were someone who has been holding this over the last 10 years, well, you would be up 223% on share price alone. So that is very, very strong in terms of an increase, and we can see it did hit its all-time high towards the back end of 2022 at around $500, so around 15% upside to the current trading price. Now, in terms of the company as a whole, do you know on the show we like to see 3 to 7% as a minimum to the top line growth, 53.8 billion in terms of 2018's top line, December 22, 66 billion. So we can see an increase from 2018 to 2022, so that is positive to see. And then when we look on a more granular level, we do in fact see increases all the way to 2021 before a small drop in 22. And also do note, based on the trailing 12 months, we are expecting another increase to the top line. So overall, it is moving in the right direction. There is some small inconsistencies, but nonetheless, it does look to be a healthy growing company. In terms of the bottom line, what is the story there? Well, 5 billion reported net income 2018, 5.7 billion in 2022, so around 15% increase to their effective bottom line. But again, on a more granular level, we do see an increase to 2020 before dropping down to 2022. Although again, do note a similar story. We are expecting a very strong bottom line report given their trailing 12 months of a net income of 7 billion. So both top line and bottom line are increasing. Yes, there are some bumps and some increases and decreases, but overall it is looking very strong. Balance sheet total health check, well, total cash versus total debt, 772 million of cash and short-term investments in 2018. The latest quarterly report, 3.6 billion. So they are holding a significant amount more cash than they did 5 years ago, which is always good to see. And when we compare that numerically and directionally to their total debt, well, 14.1 billion and has increased to 17.4. So it has increased roughly in line with the increase in cash. So it doesn't look to be a bad balance sheet, and we can take a look at the net debt to EBITDA metric shortly to see how strong this company is. Now, in terms of some competitors in the aerospace and defense essential industry, we have RTX Corporation, Airbus, the Boeing, as well as a few well-known others. Now, year to date, LMT, including those dividends reinvested, they are roughly the middle performing in the industry, down around 4%. Now, if we look over the last 5 years, in actual fact, what we see is LMT up 79%, the second best performing in the industry, coming a close second to Northrop at NOC with a 101%. So, a decent return over the last 5 years if you were reinvesting those dividends, but do remember, as always, that past performance is never an indicator for the future. Institutional ownership, it is sitting at 74%, as we can see. In terms of the outflows, well, around 7.5 billion worth of shares sold over the last 12 months. During the same period, roughly the same, slightly more buying over that period. So we can see that institutions are buying and selling roughly the same amount. Although do note, for the last 3 quarters and all in 2023, there have been more selling of shares by institutions than buying. And if we have to go back to Q4 2022 to see the opposite. But as always, personally, I disregard what the institutions do. It doesn't affect my investment decisions, but it is just one piece of the investment that I do like to look at. Now, before we jump into the dividend safety, we can take a quick look at how they performed in terms of their earnings versus analysts. Now, their latest quarter, Q3, a beat to the earnings per share, a beat to the top line. Very nice to see a double beat. Q2 of the same year, again a double beat. Very, very nice to see. And when we take a look at Q1, again another double beat. So they have beaten on their earnings from Q1 to Q3 this year. Very positive to see. And what I'd like to do is quickly analyse Q3 23 versus Q3 22. A slight increase to the top line by 2%, lower in terms of that bottom line. Diluted earnings per share, a very slight increase, but on their margin and operating income, again, a miss. So Mixed, I would say. They have beaten analyst estimates, but as always, we should always compare how they're doing to the prior year, and we can see it is fairly mixed in my opinion. I would have liked them to increase their top line by a larger amount, but we'll analyse their full annual report very soon. Now, in terms of that dividend safety score, we see it is 84. It is very safe. Market cap 111 billion, a mega cap company. Now, in terms of recessionary metrics, well, increased the dividend during the 07-09 recession. Pretty much flat, negative 1% sales, but was above the average. And recession return slightly outperforming the S&P with a negative 46% return versus the S&P's negative 55%. Dividend growth, I mean, this is okay in my opinion, 5% in the last few months. It is higher than the average inflation that we target and advocate on the channel of 4%. Last 5 years, 9%, that is nice to see. Last 20 years, double digits, but I would like to see more double-digit increases. And based on their sales, I would like to believe that 2024, we will see a nice increase above 5%. In terms of dividend growth, well, 20 years consecutively of increases, 5 years away from becoming a dividend aristocrat. Now, in terms of dividend yield theory, as we can see, we have our sign of undervaluation as the current yield sits above the 5-year average. But remember, we don't look at any of these models in isolation and we'll draw our conclusions towards the end. Forward PE sitting at 16.9, so slightly higher than the 5-year average of 15.6. And we can see it is slightly lower than the industrials PE of 18.6. And as we mentioned at the beginning of the episode, it is right there in the middle of that 52-week price range. Now, in terms of the free cash flow payout, now, we always target 60% or lower for the majority of companies, and I'm happy to say that it has pretty much been below that every single year. We see one red flag year of 2018, but given that was quite some time ago, I'm personally quite happy with the last 4 years, and 2023 is expected to be around 52%, so that is quite nice to see. And I would like to believe that 2023, or 4 in fact, we will see a much larger dividend increase. Free cash flow per share, well, 11.60 in 2013, more than double in 2022 at 23.30, and it is expected to be slightly lower in 2023, so something just to be aware of, and also to note the inconsistencies where it does increase and decrease. It isn't a company that is fast growing, so always good to understand what company or type of company you're investing in. Sales growth, now we can see here, there are some years of negative growth. In fact, their latest year, 2022, although note 23 is expected to be higher. But overall, on average, I would say it isn't too bad. It is keeping up with inflation at the minimum. And when we look numerically, we can see 45 billion in 2013 and 66 in 2022. On top of that, they also return excess cash to shareholders by doing share buybacks, as we see very consistently over the last 10 years. So that is quite a nice plus for Lockheed Martin investors. ROIC, will absolutely smashing it out of the park, above 10% every single year. The last few years in the high 20s, the mid 30s, so that is quite strong, with 2023 probably expected to be around the mid 30s again. So management are really able to effectively allocate their capital. Operating margin around that 12% consistently year on year, some years slightly below, some years slightly higher. 2023 in fact is meant to be quite nice, above that 12%. Same that can be said for the free cash flow, although it is a lot more consistent and above that 5%, with 23 expected around that 9%. Net debt to EBITDA, it shows the strength of the balance sheet as well as this dividend safety. These are all the number of years it would take the company to effectively pay off all of their debt net of cash on hand. And we can see 1.95 in 2022. 2023 expected to be slightly lower. So the dividend does look to be safe, the balance sheet does look to be strong, and before we do jump into the valuation model, let's take a look at some positives and some things just to be aware of with this company moving forwards. Now, for those that are new and don't really know what this company is, well, essentially they are a defense contractor, and with the ongoing war in Ukraine as well as the rising tensions in the Middle East, you would imagine a company that is in defense will have a lot more contracts going towards it. And when we take a look at essentially who those customers are, we can see that effectively they are primarily governments and they do have some commercial customers. What do? Well, they design and develop advanced technology systems in aerospace defense and information security. We can as well see that they are the world's largest defense contractor by total sales, around 46 billion in contract obligations, which is huge. given that it is well ahead of second place RTX of 26 billion and General Dynamics of 22 billion. And as we mentioned, the US government is effectively their largest customer, around 73% of their net sales, and the Defense Department around 64%. Foreign military sits at around 26%. Now, you would expect, where the government are essentially one of their biggest contractors, you would expect going forwards to have stable cash flows, which personally I don't see that changing for the long term or foreseeable future. One thing also to note that they do have quite a strong backlog, which is sitting right now at around 156 billion. So I don't believe this is one where you could argue that they will run dry in terms of customers or in terms of government contracts. And we can see the US Defense Department are always looking to buy. They are currently waiting on around 2,500 F-35 aircrafts, which is around 400 billion. And on top of that, something that you need to consider as well, not just buying these products, not buying these essential products yet, you are also looking at buying services, so the maintenance of the planes, which is around a 1.27 trillion over their 66-year life cycle. So it would be interesting to see if anyone does believe that there are any issues that Lockheed Martin will face in terms of their clients. Now we jump into the valuation model. As always, if you do enjoy the content values being provided, smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And do click on that pinned comment below so you can grab a copy of the valuation model, getting to the intrinsic value and acceptable buy price of companies in your own portfolio. Jumping on to the first model, we have Graham's valuation, where we have the stock ticker symbol, earnings per share growth rate, current yield on AAA corporate bonds, to give an intrinsic value of $483. Now when we take a look, that is some nice upside to the current trading price, just shy of 10%, but it is still within that 52-week range, so we do see some signs here of undervaluation on the first model. Then we have the multiples valuation model, companies in a similar sector and size. Once we get their average PE, multiplied by the earnings per share to give a stock price of 565. Now not only is that above the current trading price, but it is above the 52-week high and above their all-time high. So we do see signs based on the multiples valuation of some severe undervaluation. We then move on to the DDM model, where we have the yearly dividends, the average growth rate moving forwards. Now I have gone for around 5.25%. You could argue higher or lower. If you grab a copy of the model, you can play around with these numbers. Gives a DDM price of 482. Again, nice upside to the current trading price, but within that 52-week range. We then move on to the final model, the DCF model. We have the free cash flows. We have the average growth rate. We have the growth rate forward looking based on analyst estimates, although we have gone a bit more conservative. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $502. That is essentially above the current trading price and pretty much at that 52-week high. Again, we have our fourth sign of undervaluation. So the intrinsic value, as always, is purely the average of these four models. And again, if you enjoy the content, smash that like button, hit the subscribe and bell so you are continually notified of these videos. Margin of safety then, remember 10%, wide moat, strong financial metrics, good forward-looking data. If you believe it hits those criteria, then right now it would be a buy up to $457. Now, for those that are looking for a larger margin of safety, you would be looking around 430 for a 15% margin of safety, and at 20% it would be around 406. Now, this is one that I don't have in my portfolio. The industry as a whole isn't one I have either, but it is one that I will be looking to add. Again, I am very patient with these things, so around $400 to $410 is where I will start to dollar cost average at a 20% margin of safety. In terms of Wall Street, well, they see there is some upside to the current trading price at around $483, so they do believe just shy of 10% to the current trading price. So what we are saying right now is that if you were to lock in the price now, you were, based on our estimates, getting a 10% margin of safety as well as a 10% upside per Wall Street. As always, let me know your thoughts. Is Lockheed Martin one you have been adding? Was it one you were adding when it was down at around $400, $410, which doesn't seem like that long ago? Or if there are any reasons why you're not looking to invest, do let me know in the comments as well. As always, do click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio. Don't forget to smash the like button, hit the subscribe and bell so these videos do drop to your doorstep as and when they get delivered. And as always, have a great day and see you all on the next one. Take care.